back. Well, let's move on to our next guest. And we have with us Candace Browning, Head of Global Research at Bank of America. And actually, Candace is with Nigel, who has, of course, been camped at the conference right from the morning, picking up all the action over there. Nigel, what's happening?
Well, thanks a lot for that, Surbhi. Well, Candace, always a pleasure talking to you. Thanks a lot for joining in here on CNBC TV18, and congratulations on the conference as well.
Thank you.
You know, since it's an election year, both here in India as well as the United States, the stock market seems to be a little bit skittish. But data points prove, or history proves, that actually equity markets do quite well in election years. Tell us more about that statistic.
Yeah, that's absolutely true. On average, if you go back in the U.S. over multiple elections, the market is typically up 11% on average during an election. There can be a lot of volatility, but typically the market is up.
Okay, all right. So U.S. markets, in fact, they do well in an election year, which is quite interesting. Tell us, do you have a level on the U.S. markets? Because the mother market has been doing well, and that obviously helps an emerging market like India when you have some stability out there. But do you have a level on the S&P 500?
Yeah, on the S&P 500, we're looking for 5,400. So, sort of very modest upside from here. I do expect that there will be some volatility.
Okay.
In fact, if you look at it on average in each year, there's about a 5% down movement. So I expect there will be volatility, particularly in an election year.
Right.
But we're looking for 5,400, and that's really driven by earnings, because it's earnings and profits that drive stocks, at least in the United States, not elections.
Indeed. Since we're talking about the United States, what stands out is the kind of move you're seeing in the Magnificent Seven. And NVIDIA has been in a world of its own. In the last, if you plot a 1-month chart, a 1-year chart, or an 18-month chart, that stock has been on fire.
Yeah.
So tell us about, how do you see the Magnificent Seven pan out, as well as a quick comment on NVIDIA.
So basically, if you look at the Magnificent Seven, they are 7 disparate companies. And in fact, we at Bank of America, coined the term, the Magnificent Seven. So what you're seeing is that if you go back to last year, you saw the earnings growth of the Magnificent Seven was dramatically higher than the rest of the market. But what you're going to see going forward, and you've already started to see, is that those two earnings growth ratios are coming together. And by the fourth quarter of this year, we think the Magnificent Seven earnings growth will be about 15%, and the 493 will be 14%.
Oh, okay.
And so we really think there's going to be this broadening out of the market to the 493.
Right.
We still have a buy on NVIDIA. We recently raised our price target on it. We see great things ahead for NVIDIA.
Okay, so the U.S. market seems to be in a good space as of now. But let's come back home to India, and let's talk about the emerging markets. There's been that toss-up between India and China. And I think y'all had a tactical call that China will do well in the last few months, from January onwards, if I'm not mistaken. What's the call right now? Because India's got some political stability, earnings, as you said. That's the fundamental driver for markets ultimately. Stability, policy continuity, and we seem to be in a sweet spot. How do you all toss up the two now between India as well as China?
Well, basically, as you said, we think tactically that there's some reasons to be constructive on China. If you look at, as a matter of fact, in January, pessimism about China reached the highest level ever.
Okay.
And then after that, we started to see some reforms. We've started to see, some better economic data come through. So we're constructive on China in the short term. But in the longer term, we very much prefer India because of the demographics, because of that they're just beginning the growth cycle that China started, decades ago.
Yes.
There's a whole host of reasons why we're more positive on India longer term than China. And on emerging markets overall, I would say that if we have a soft landing in the U.S., that means we're going to have a takeoff for emerging markets.
Okay. Since we're talking about China, what's happened with China, the policy measures we've been getting from the government out there, as well as the central bank, is that commodity prices have moved up. At some point of time, that could be a bit of a risk for this, this inflation cooling off. How are you all placed on commodities, if you could comment on that? And given inflation could again, perk up a little bit, what are you all factoring in terms of Fed action for this year itself?
So basically, as it relates to commodities, on the energy side, we think the demand has been a little bit weak, and the energy prices have been, largely driven by geopolitical concerns. And remember, the United States is energy independent, right? And so energy we're not really concerned about, but copper and other base metals, we do see a very large demand for those base metals, particularly as we go through the green revolution, AI, et cetera. We need all of those metals to fuel that revolution. And as it relates to the Fed, what we're looking for there is we're looking for the first cut to happen in December.
Okay.
And then we're looking for 4 more cuts next year, and we think we'll probably end with the terminal rate in 2026 of about 3.75%. Now, the risk is because, we've all been waiting for these Fed cuts all year. But obviously, the risk is that inflation comes in even hotter and the Fed doesn't cut at all.
Oh, all right. And you're penciling in a first cut in December itself,
yes.
Right? We started this year thinking that maybe March you get an outside chance to get a cut. Then we said maybe in the middle of the year, September, but you're saying maybe December. And the risk is maybe we don't see one.
Well, one of the reasons is because the U.S. consumer has been so much stronger than anyone predicted. The U.S., the great preponderance of mortgages in the United States are fixed rate.
Right.
So if you have a fixed rate mortgage and you don't have very much credit card debt, inflation really doesn't impact you very much. Right. So we've seen the U.S. consumer, not be impacted by rising rates. Plus, we've seen good growth in wages and a very solid job market. So the U.S. consumer has held up very, very well.
Indeed. And just to get done with the word on commodities, and then I think my co-anchors would want to ask you a couple of questions. Copper is something you're still bullish on. And what about gold?
We're bullish on both copper and on gold. Copper really is a function of, the change to EVs, and gold really is a function of the central banks wanting to diversify away from the U.S. dollar.
Okay, all right. Well, I think Surbhi and Rima want to come in as well. Go ahead.
Yeah. Thanks for that, Nigel. I just have one quick question for Candance. Great listening to you, Candance, and appreciate you being with us. So at 5,400 on the S&P 500, you're not expecting much of an upside, in the U.S. market. And the other point you made is extremely important as well. Convergence of the earnings of the Magnificent Seven with the rest of the market. So are you predicting a scenario where perhaps returns start flattening out for the U.S. market? And if that were to be the case, can we expect more foreign flows here in India? Because foreign flows have actually been absent. This is a domestic-led rally here so far this year.
Well, yes, and that's kind of what I was trying to say before when I basically said that if you get a soft landing in the United States and earnings growth and GDP growth in the United States moderates, that means that there will be a pickup in growth in emerging markets. So yes, I think that would be very positive, for example, for India, which is our favorite pick among the EMs.
Candice, morning. So the FPI holding in India is the lowest that we've seen in the last, in over a decade now, despite India being a favorite over the longer term. Do you see that reversing anytime soon?
That's hard for me to predict, to be quite frank. It depends on a lot of different factors. Certainly it should, but it depends on a lot of different factors, so it's a hard one to call.
Candance, if at all you've looked at this market in any more detail, since this is your top emerging market pick, what do you like here? I mean, some of the manufacturing themes, capital expenditure, those stocks have run a lot in the country, but do you still like them?
So when we look at stocks over, a 1 to 5 year period, and we love the long-term setup in India with the demographics that you have here, with the pro-growth government. We like all of the long-term setup in India very, very much. Plus, remember, while India is very expensive, emerging markets overall are not particularly expensive. If you look at the U.S. market, it's trading at 21 times. The rest of the world is trading at 14 times. Well, yes, India is relatively expensive, but it's also the largest economy that's growing this rapidly and likely to do so for the next 5 to 10 years.
All right, Candice, it's been a pleasure hearing your thoughts. We've taken note of all the points you made. U.S. markets normally do well in election year. India, well, it's a structurally good story. Earnings ultimately will drive performance. And in terms of commodities, gold as well as copper, those two you're bullish on. Wishing you a good conference. And thanks a lot for speaking to us here at CNBC TV 18.
Thank you, Nigel.
Well, back to you all in the studio.
Okay, Nigel, thanks very much for getting us that conversation. Do have to take a quick break on that note. Come back on the other